based on this chart, it is showing that we could see gold slip 38, 3,600. It might happen very quick. I do feel like we could see a little bit of some type of news, probably spark some short-term margin calls and create something like this where we have a huge lower wick and then a sharp rebound. The sweet spot is typically the 38 to 50% retracement of that move. Silver has similar type of price action. It's kind of significant. There's a little breakout level, support, and it's kind of broken down and has a little bit of a bearish pattern. So silver is already kind of giving way along with platinum and palladium. And I do think we are going to see metals have one more push down. And I think it's going to be fairly violent. When we look at silver, using Fibonacci, we have the initial leg down and we've got this bounce. It is pointing to still a very sharp drop for silver, right? It is pointing to about $40 per ounce. And that's why I'm excited, because I love silver. It's probably going to bounce right back up into the 60 range. Silver or gold is to find traction right here. This huge super cycle and the blow off phase and this correction down is saying that if it hooks up and starts to move higher, we're looking at about 8,500 for gold. So
here with the precious metal projections, very interesting month of June, Chris, that was driven by some, I don't know if we'll call it fundamental factors or not, but I mean, I sat there and watched Warsh expecting him to be more dovish than what the market was thinking. And he actually came in more hawkish. And that was quick to trim about 10% off of gold and, geez Louise, maybe almost 20% off of silver in a week. We're now banging around trying to find a base. Let's start with gold. What do you see, my friend?
Yeah, well, when we take a look at the precious metals charts here, gold, I mean, it is trying to hold on to this kind of low, this little congestion area where we had a lot of volatility traded through here late last year. And then we saw a market have a huge washout low, a big high volume low and a bounce. It's found that level again, it's bounced, and now it is just clinging on, hoping it can hold this level. But the overall trend right now is getting a little bit mixed here. We got the longer term trend still more or less holding up. The shorter term trends are pointing to lower pricing, meaning it's going to want to naturally follow that trend. A trend is more likely to continue. And so it is still pointing to a little bit of a precipitous fall here. This is a high momentum move.
The Fed sounded confident, yet gold reacted like confidence had already cracked beneath the surface. Chris Vermeulen notes that short-term momentum has weakened even as the longer-term structure remains intact, exposing a market caught between institutional positioning and public reassurance. Sharp declines often force emotional selling before stronger hands quietly accumulate. Investors focused only on headlines may completely miss that transition. Next, Chris Vermeulen exposes why this technical weakness could become the strongest bullish signal of the entire cycle.
And based on this chart, it is showing that we could see gold slip 38, 3,600. It might happen very quick. I do feel like we could see a little bit of some type of news to come out that could create a bit of a slide here. I think it would probably spark some short-term margin calls and create something like this where we have a huge lower wick and then a sharp rebound. We've seen it happen a few times. So I'm actually pretty interested to see when this is going to happen. This chart is pointing to, like, in the next week or two, we could see gold slip right to 3,600, and it'll be a very short-term, a very short-lived moment. I was telling this to subscribers yesterday, saying you need to be ready, because at any point I think we could see some event and gold has some crazy spike, washout low, and then quickly rebounds, and it might be a very significant low on the chart. When we look at the chart using Fibonacci theory, it's pointing to about 3,600. This is telling us, based on the initial sell-off and the strength of the bounce, it's telling us we should find some type of short-term support at the 618, which is the golden ratio. This is a level where just things in the universe tend to find support or resistance temporarily. And if it does have a bounce there, we almost always see the asset class move to the 100% measured move down here. So I'm really interested to see and waiting to pull the trigger to pick up a bunch of physical metals down at this level and potentially start to see it build a base after that.
Sudden market shocks rarely surprise institutions because they're usually positioned before the headlines arrive. According to Chris Vermeulen, a rapid drop toward key Fibonacci support could trigger forced liquidations before reversing just as quickly. That possibility raises an uncomfortable question. Who benefits when retail investors panic out while physical buyers quietly step in? Missing that brief window could reshape long-term returns more than months of daily price watching. Next, Chris Vermeulen reveals why violent sell-offs often conceal institutional accumulation instead of genuine market weakness.
The big question after that, Craig, is like, how big of a base is this going to take? Like, could it take 3 months, 6 months, before it starts to move higher and start to rally? That's the big question. But I'm gunning for and looking to buy metals, or gold specifically, at 3,600.
Chris, we use those Fibonacci levels on the way up quite effectively. Yeah, I remember you talking about once you get through that 618, you almost always go to the 100 level. So I certainly see why it would work on the downside. What can you nail down that 618 level for what that would be for people to watch?
For the downside or for the upside here?
Yeah, if that gives way in the days ahead, what level is that?
Well, this level here to the downside will be 3,600.
No, the one that if the 618 level, if the 618 level gives way, what is that 618 level?
Yeah, sorry, that's about 4,100. It's right where gold is trading right now, 4,000, 4,100. And so it's just kind of flirting around this orange line. If I zoom in, you can see it a little bit more. It's tagged this level, bounced off it, and so this is that level, and it's kind of already below it and losing traction. It's kind of slipping. So I think this is an amazing opportunity, and I think you need to have Sprout on speed dial so that you can pick up some metals if we get this very sharp dip.
Most investors fear falling prices, but seasoned buyers often fear missing them instead. What Chris Vermeulen is highlighting is that the critical level isn't simply a price target, but a decision point where institutional accumulation can begin while sentiment remains deeply negative. Retail investors frequently confuse volatility with permanent damage. Next, Chris Vermeulen unravels the confirmation signal that could separate a temporary washout from the start of gold's next major advance.
Chris, what if, on the flip side, that 618 level holds, and that this recent dip from 4,400 down to whatever the lows were back on Monday evening, 39.56 or something like that, what would you be watching for in a recovery to go, okay, maybe the worst is over?
Well, what I would look for would be like what I call an impulse move. So what we want to see from a technical standpoint is we want to see price have very strong momentum. And so if we look at these previous highs, so we've got a previous high over here, we've got another previous high over here. Now, an impulse move means the market has a strong move, an impulse move. It's busted through two resistance levels. When you break through two ceilings, that first pause and pullback is usually an opportunity to get in before it starts the next big run. And then, it'll rinse and repeat through these bull flag patterns. So that's what I'd be looking for. And gold, it's a long ways up. Right now it's at 4,000, right? It would need to really get to about 4,600 to break out, and then a pause from there. And that'll say, hey, the momentum has shifted from a downtrend, which is lower highs and lower lows, to now it's broken a bunch of highs. It has a higher high. And now we're looking for to create like a higher low, right? And when it starts to turn up and break out, you could be like, okay, this train is leaving the station, and the next move is going to be significantly higher.
Recoveries rarely announce themselves until institutions have already taken their positions. Chris Vermeulen's argument suggests that breaking multiple resistance levels matters more than reacting to a single strong trading day because momentum confirms intent. Waiting for that confirmation may sacrifice some upside, but greatly reduces unnecessary risk. Next, Chris Vermeulen reveals why one breakout pattern could invalidate today's bearish narrative almost overnight.
We can get a gauge of where that is if we look at the weekly chart and we go back to the previous kind of major lows here for gold. We'll kind of go right back to here, the 2014 lows. We can get right here, 2015 lows. We can get a gauge based on if silver or gold is to find traction right here. This huge super cycle and the blow off phase and this correction down is saying that if it hooks up and starts to move higher, we're looking at about 8,500 for gold. So, that's a pretty nice double from kind of where it is right now.
over the
But
next
there's a lot
year.
of upside. And
Yeah.
so that's what's really exciting. And obviously, if gold pulls back lower, if it does pull back to that Fibonacci level, it lowers the target as well. So if we go to 3,600, gold still would move to about 8,100, which is obviously still a very significant move. In fact, if we move these levels down, it actually provides more opportunity, about 30% more potential if it goes down to that level.
I'd point out to people that 8,000. Well, over the last 10 years, gold's gone from 1,100 to 2,000 to 5,000. And the debt keeps increasing and the money supply keeps increasing. So why in another 5 years wouldn't it go to 8,000? So anyway, Chris, back to your charts, however, I think that's extremely helpful. I mean, we want to really if we start washing out below 4,000, that gives you some idea of what might be coming.
Exploding government debt keeps expanding while the purchasing power of savings keeps shrinking. This is where Chris Vermeulen's thesis shifts from short-term volatility toward long-term wealth preservation, driven by monetary expansion rather than speculation. Investors obsessed with daily swings often ignore the larger trend quietly eroding their cash holdings. Next, Chris Vermeulen exposes why temporary weakness could actually improve long-term upside for disciplined precious metals buyers.
Let's do the same exercise with silver.
Sure.
There are some old highs after we first broke through 50 from November and October of last year at around 54. I mean, we're trying to find some support near there. What do you see?
Yeah, so silver has similar type of price action. And this actually goes, silver, platinum, and palladium actually all have very similar chart patterns. They're really trying to cling on to this kind of significant, there's a little breakout level, support, and it's kind of broken down and has a little bit of a bearish pattern. So silver is already kind of giving way along with platinum and palladium. And I do think we are going to see metals have one more push down. And I think it's going to be fairly violent. When we look at silver, using Fibonacci, we have the initial leg down and we've got this bounce, and it is pointing to still a very sharp drop for silver, right? It is pointing to about $40 per ounce. And that's why I'm excited, because I love silver in that way, because it is extremely volatile. And when if we have this, just the way these charts are unfolding, I feel like we're going to see some event and there's going to be margin calls and we're going to have a very sharp drop. I love it. If we can get silver down to these levels, it'll be like back the truck up, because it'll be a very short-lived window. It may only tag 40 for minutes or maybe even hours and rebound, right? That's what this chart is kind of pointing to.
Silver's greatest opportunities have historically appeared during moments of maximum panic, not maximum optimism. Chris Vermeulen notes that a swift decline toward key support could reflect forced liquidation rather than collapsing fundamentals, creating an opening institutions rarely waste. Investors who separate price volatility from long-term value usually make very different decisions. Next, Chris Vermeulen reveals why the fastest sell-off could become the strongest buying opportunity in precious metals.
It's going to be a couple big red bars, and then it's probably going to bounce right back up into the 60 range. So this is what I'm keeping my eyes on for. It's a very short-term opportunity to pick it up at a killer deal. And it would dip below that 50 level. I think there'll be a lot of margin calls in the silver space, and it could be an opportunity.
Yeah, I wonder, some global equity washout or, something that just everything gets thrown out. You certainly see that as a possibility. And again, very helpful chart.
So the QQQ, and this is the same with the S&P 500. This type of volatility and the market internals that we have of money flowing and money's rotating between mega caps one day and then micro caps the next day. They're going to risk on small caps and technology and all that stuff one day, and the next day they're going into dividend stocks and utilities. We're seeing just money slosh back and forth. And we're seeing that in the volatility. We're seeing that here. It's actually very similar. This box right here is the same type of what we saw over here. So the big question for the stock market right now is like, is the market stalling out and has it kind of lost its mojo for a while? Or is this a pause and we're going to see it pop and have another huge euphoric move up?
Markets can look healthy, even while institutional money quietly changes direction beneath the surface. According to Chris Vermeulen, the violent sector rotation suggests uncertainty is growing despite bullish headlines dominating financial media. That divergence deserves more attention than another record close because leadership often weakens before prices do. Next, Chris Vermeulen exposes what this internal market rotation could mean for both stocks and precious metals.
The NASDAQ, the QQQ, is actually pointing to about a 20% move if it resolves to the upside. So we got this rally up, we got this pullback, and it is showing us that we could see the Qs rally up to about $879 per ounce, which is about a 20% move. So there is potential for us to see one more AI small cap euphoric pop and rally in the stock market. And it's on the cusp of that. The flip side of that is the market really doesn't know what it wants to do. It actually has mixed signals. And is it going to break down and sell off, or is it going to stall out over time like it did over here? Like we saw the market trade sideways for months. I mean, it went sideways for kind of 4 or 5 months very easily, and then kind of lost some of its traction and had a reset. So that's kind of where we're at. We liquidated our S&P 500 and our QQQ positions. We've stepped aside because right now the market doesn't know where it wants to go. If we look at it from like a trending perspective, like the S&P 500, the right-hand side chart is kind of the lens and the health of what we look at in the market. So it starts to become very ugly, unhealthy, and it starts to bleed out. And that's when we have these trend reversals on the left chart, which is our trend signal.
The strongest rallies often emerge when uncertainty is highest, but so do the most expensive mistakes. What Chris Vermeulen is highlighting is that mixed signals deserve patience, not prediction, because preserving capital matters more than chasing every move. Standing aside is sometimes the most profitable position available. Next, Chris Vermeulen reveals the market condition that would completely change this cautious outlook.
The market has been giving choppy signals. We pulled off some profits near the peak and we scaled out as it moved up. And now we're just waiting. We're like, when is it? Yeah. Is it going to give us a new buy signal for a leg up, or is it going to roll over? And when we look at the right side here, we got orange bars. This is telling us the market is weak. It's kind of sick, and it doesn't mean it's going to go down. It just means it's digesting the recent move. There's waves of profit taking. We keep seeing, even on the intraday charts. I think we see this if we go to the futures and look at the 10-minute chart. Take a look at the QQQ and what's been happening on the major index here. We have seen some huge bouts. The market opens up and we see just a huge drop with massive volume. And we keep seeing these like big bouts of selling at the close or right at the open. Huge volume. And then the market is very resilient right now. Every dip is people are just piling back in and they drive it back up. So there is distribution selling. There is big money rotating out of this market, but it's just there's enough people in there just gobbling it right back up saying, hey, it's a dip, I'm getting in.
Yeah.
So the market's strong because of that. It's very resilient at this phase. So that's about it.
Heavy volume doesn't always confirm strength because it can also signal quiet distribution. Chris Vermeulen's argument suggests large investors may already be reducing exposure while enthusiastic buyers keep supporting prices temporarily. That disconnect has appeared repeatedly before broader market resets throughout history. Next, Chris Vermeulen reveals the technical signal that separates healthy consolidation from institutional distribution.
You want to do one of those Fibonacci deals on the QQQs just for the sake of something to watch?
Yeah, I mean the key level here, as I pointed out, it looks like we've got about a 20% upside. So we're looking for or this is the NASDAQ. Let me just go to the QQQ because that's what most people trade here.
If it were to roll over too, Chris.
Pardon?
If it were to roll over, what would the downside be on a Fibonacci?
Yeah, so good point. So I think right here, if the market starts to break these highs, if it obviously starts to break to new highs, obviously there's no overhead resistance. The market has reset. It's starting to go higher, and you should be looking for, 879. If on the flip side, if it starts to break down through these levels, if it starts to break down below these levels here, we can use a Fibonacci retracement. And this is saying based on the strength of this rally, it's going to say, the market is going to want to pull back into these sweet spots. The sweet spot is typically the 38 to 50% retracement of that move, which, I mean, really isn't all that far down. It's about a 7 to 10% move to the downside. The big question is it just a small healthy correction, or is it something deeper that actually creates a big sell-off?
A modest correction can protect wealth if investors recognize it before emotions take control. This is where Chris Vermeulen's thesis shifts from chasing upside to managing downside through disciplined risk levels instead of optimistic forecasts. Small pullbacks often become dangerous only when investors refuse to respect them. Next, Chris Vermeulen exposes the price level where an ordinary correction could become something far more significant.
But overall, that's kind of the downside potential. If it comes down into this lower zone around 650, 675, if it builds a little bottom there and starts to turn back up, I mean, the market is most likely going to work its way up and head up into the mid 800s again. So I think the key thresholds is it going to break to new highs? If so, it's got a lot of upside potential. If it breaks these lows that we've seen from a few weeks ago, then look for it to pull back. Again, we're still in an overall bull market. And so a lot of people say like, oh, if it starts to break down, I'm going to buy an inverse ETF. The problem is in most cases, there's very little downside, 4 or 5% downside with an inverse ETF. In a bull market, those downside moves happen usually in a day or two, that drop. And then it just turns around and starts to go higher. So it's always best to go and look at the long-term picture. This is the weekly chart of the S&P 500. We want to know, like, hey, when we start in a new bull market, overall, you don't want to be shorting the market. There are these little resets along the way, but we are still in a bull market phase.
Bull markets punish impatient bears almost as often as they reward disciplined investors. According to Chris Vermeulen, short-term weakness should be judged within the broader trend because brief pullbacks rarely overturn major bull cycles. Chasing every decline can quietly destroy capital through poor timing rather than poor analysis.